go ahead and start recording. So, Patrick, I'm sure you're familiar with this screen, right? Very, very basic. This is where all the information for the person is. We do have the name of the taxpayer on this screen, and their social security numbers. That's where the address would usually go. So I guess let's start, Fanny, let's start with your questions.
Okay. I had a question regarding his income. If you go to the income, the W-2, you will see that he had, I think, three columns there: Uber, Lyft, and Google. So I went to the documents on Dropbox, and I didn't see any source of income from Lyft. So I do not know where the data came from.
Okay. Let's see. All right. So okay. So we have a whole bunch of different 1099s. We do have 5498, trade-in, traditional IRA forms. We have quite a few K1s. We have interest. Okay, so first, W-2. Okay, so this one is from Uber.
Bottom, well, down. 1, 2, 3, 4, 5, 6. Yep, right there.
Oh.
Okay, and as you guys can see, that's why I always use the actual Dropbox app, because for some reason, when I use it like this, it just does not want to work. But good point, right? So usually we need to scout all of the documents that the client provides, and then we'd go ahead and input them. So there we go. We do have Lyft W-2. And this is Chuan Xin, so I'm assuming that's the spouse.
Spouse, yeah.
So one important thing, right? Lyft, and we can see spouse. So what is the actual reason that we are marking that this is the spouse and it's not a taxpayer? This brings us to a very interesting portion of the tax code. So if you're going to look at a W-2, there's always going to be box 1 that are wages, there's going to be federal income tax withheld, and there's always going to be Social Security wages, okay? Social Security wages, not the full amount, is subject to Social Security taxes, okay? Only, for example, for 2021 tax year, only up to $142,800 per taxpayer was subject for Social Security taxes, okay? So you will see that if the taxpayer has, in this case, the spouse has 2 W-2s, and we'll talk about that. But in his case, right, 132,900, so I would say that, let me see. Easy way to check if you see that these wages are the same. So we know now for 2019, the limit for Social Security wages for specifically Social Security tax withholding was 132,900. Now, what does that tell you? That whomever had two employers, okay, whomever had two employers, if their wages, total wages from both jobs, were over that threshold, were over 132,900, let's say for 2019, for 2021, over 142,800, they will have Social Security taxes refunded to them because they have overpaid. So when we click on preview, the way it shows up is it will show up as a credit, okay? Yet another interesting thing that we're going to touch on. So we will see that there is, you know, on one hand, there's always going to be other taxes. This what increases the tax liability. On the other hand, we're going to see various prepayments. And so we're going to see Schedule 3 has prepayment that is actually a credit that will be offsetting how much they tentatively owe, okay? Credit, the way the credits work, they offset potential tax liability or potential total tax liability dollar for dollar. This is the potential tax liability. Which means that if the credit is $5,000, let's say, it's going to be 514,1666 less 5,000. That's what the person would owe. However, we'll always, well, most of the time, we're going to see federal income tax withheld if the person has actual W-2 or 1099. And by this 1099, most of the time, they mean actual retirement, 1099-R. This is where most commonly you will see the withholding. And of course, we have various credits here, okay, various credits. But yet again, I'm going to stress dollar for dollar, okay? Unlike deductions, okay, deductions reduce adjusted gross income. So they take the highest tax bracket that the person is in, and they lower that highest tax bracketed income. So in order to explain to the person how much they're actually saving on their taxes, you would say that they're literally here in 37% tax bracket, no matter how you put it. You would do 24,400 times 37% converted into a decimal times 0.37. That's how much they saved on their potential tax liability, okay, by taking standard deduction.
Okay.
Oh, and let's take a look at Schedule 3. Schedule 3 is going to show you additional credits and payments, right? And that's where we said that where's that large amount coming from? These are excess Social Security and Tier 1 RRTA tax withheld. So most of the time you're going to see this, okay? It's excess Social Security, especially with the clients that we have. Also, that's where the foreign tax credit is going to show up, but the foreign tax credit, if we actually go, accidentally close that. If we actually go to the Form 1040, it shows up sooner, okay?
Yeah.
And then below, we're going to see that. Now, if we compare this number, 7,118, to the second W-2 that the spouse received, right? It's going to be exact same match, okay? Because from the first employer, from Lyft, she already had the maximum withholding. So whatever was after the max, let's say Google in this example, is going to be refunded to them, okay? Okay. So what's the next question?
Yeah, and also while I was reading on W2 and 1099K and K1, I was trying to understand, okay, Charles Ma, he also had shares at Uber. So I was trying to understand why those shares were not under 1099K and they were under the W2, because it's not like direct income from employer. It's like an investment.
Penny, I couldn't really hear you all that well. Maybe could you paraphrase the question? So
Yes.
the question is about the shares. That portion I understood, but what about them?
Yeah, I thought that since they were interest, they were not going to be calculated as part of the W2, but rather as part of like 1099K or NAC. Can you hear me now?
Yes, but I feel like I don't understand the question.
Okay.
Would you like me to jump in and try and paraphrase it as best I can?
Yes.
I think that what she's asking is she's confused that the Uber shares of Uber are calculated on the W2 and not through a 1099 form.
Oh, yes. Okay, that makes sense. So, great question. The way these, if I could open it up, but there are certain types, and we're going to pull it up here so we can actually see it. So if you're going to look at the W2, it's a very, very specific code in the tax law. Okay, there are various stocks that employer can offer to employee at a discounted price, okay, or a discounted value. So what happens is if employer is offering these discounted stocks, they are considered part of the compensation, okay? Since they are part of the compensation, whatever the difference is, usually, okay, because there's different ones. There's RSUs, there's ISOs, NSOs, employer-sponsored plans, and purchase plans of various names. But right now we're looking at RSUs, which is restricted stock units. So the way that these work is the difference between however much employee paid for that stock unit versus the fair market value, okay, is going to be included as their compensation, okay? But to avoid double taxation, this will also, in addition to whatever they actually paid for it, will become the new basis for the shares that they act for the shares. So when they sell them, they're not going to be twice taxed on this, okay? So even though in the year that the restricted stock units vest, okay, and employee receives them, even though they're included into ordinary income, there's not going to be a double taxation, because then employee gets that as adjusted basis. So when they sell, it's going to be sales price less this amount, and it could either be gain or loss. Okay.
Okay.
Now, the reason that it is beneficial for a lot of taxpayers to actually receive RSUs is, if we're going to look here, I don't see any adjustment to basis, and I do feel like there should be one. So, for example, if these were the same Uber shares that that person has received, so let's say the vestment date was such and such, not vestment, sorry, the sales date was such and such, and let's say they vested before that. So date acquired would be the date when they actually vested, okay? Date disposed would be when the person actually sold them. Proceeds are going to be whatever they are. Cost bases are going to be what employee actually paid for the shares, but there's going to be amount of adjustment, and I am just oversimplifying this a little bit, but there is going to be amount of adjustment that is already included into the W-2, okay, proportionally. Let's say if they didn't sell all of the shares, then of course it's going to be lesser than included in W-2, but the basis will continue carried forward. If the person actually waits, okay, waits to sell these shares, and this is a short-term transaction, so it's very not beneficial for the taxpayer. Why is this not beneficial for the taxpayer? Because short-term transactions are subject to ordinary income tax rates. In this person, we can see that their federal marginal, well, doesn't matter, marginal effective, it's effectively they're going to be pretty high as well, but marginal tax bracket is 37%. What that means is this income just gets slapped on top of their W-2 income, and they're paying heaps of, taxes on it. Whereas if they actually were to wait, okay, if they actually were to wait and not sell the RSUs and hold them longer than a year, the RSUs would be subject to preferential tax rates. Preferential tax rates are specifically for long-term capital gains and qualified dividends. And there is a worksheet to determine that, and it's quite literally called Qualified Dividends and Capital Gains Tax Worksheet. It's a very handy-dandy tool. The calculation is done for you. You just follow it, and if the client has a question, you can explain to them. But the gist of it is that the qualified dividends and capital gains are taxed at 0, 15, and 20%. On rare occasions, there could be additional supplemental statement. If the person has sold works of arts, it will be taxed at a 28% tax rate, okay? But that's very rare, and honestly, I feel like unless we acquire a whole bunch of art dealers, it's a moot point to discuss that. One interesting thing that can be a surprise, especially if it's the first time you're reviewing a return like that, or if you're trying to explain to client why they're paying 0 taxes. If there was a situation where the person got 0 wages, 0 interest, 0 dividends, 0 IRA distributions, you can call them IRA or IRA. There's no debate about it, equally correct. So nothing like, so no income other than long-term capital gains. The person can have long-term capital gain in a given year. For example, for 2019, it's going to be $78,750 for married filing jointly individuals. If you're going to look at 2021, it's $84,000 and change. And if it's the only income that they have in that year, they will be paying 0 taxes. 0 taxes. Very important. If you ever see a tax return like that, don't get startled. It's not a glitch in the system. It's quite literally following this worksheet. They're going to be taxed at 0. Okay. However, this is not this person's case. Most of their capital gains are going to be taxed at a 20% tax rate. So, well, actually none in this case. And this is what we can see here, because the only portion that is taxed at a preferential tax rate is qualified dividends, a little bit of them.
Okay.
Yep. So that's when it comes to short-term versus long-term capital gains. Now, usually you would see these on Schedule D, okay? And Patrick, just to briefly catch you up, and we're going to be stopping, on all the schedules, but to briefly catch you up, within the 1040, we can find quite a bit of different schedules. that are actually letter schedules that then flow into numeric schedules. Okay, so Schedule A is itemized deductions. Schedule B, that's dividends and interest. Schedule C is business income. Schedule D is capital gains and losses. Schedule E is quite a fun beast because Schedule E has 2 pages, and we can see this is a bright example where not 2 pages are reported. Only page 2 is reported. So in a way, Schedule E consists of 2 separate schedules, which is Schedule E page 1 and Schedule E page 2. Schedule E page 1 is a rental properties and royalties. Schedule E page 2, you're going to see income or loss from partnerships and S corporations, income loss from estates and trusts. So all of your pass-through entities, the entities that actually don't pay tax on their own, instead, they file merely informational tax returns, and then the person who actually owns portion or all of that entity receives a K-1 and in turn reports it on Schedule E, page 2. The funny thing is that you can have, multiple Schedule E page 1s, but you will only see one Schedule E page 2. And if it's too many of them here, it's going to show as a statement or a supplement. Okay.
Okay.
So the poor Schedule E page 2 didn't get as much of attention as Schedule E page 1. Okay. So going back to the Schedule D. Schedule D, this is where the, think of it as a snapshot, as all of the capital gains and losses are gathered together and happily reported between the short term and the long term. This will not show you which specific brokerage, reported that transactions. These are going to be pretty much reported in bulk based on the way they're treated, okay? What does it mean based on the way they're treated? It means that if it's a short-term or long-term transactions, you can have a few scenarios. First scenario, the person received 1099-B where the bases were actually reported to the IRS, and you will receive that reflected on the form. It will specifically say, let's say, short-term transactions with the bases reported to the IRS. Sometimes the person can receive 1099-B, but the bases are not reported to the IRS. And then, of course, there could be a situation where it's a short-term transaction not reported to you on Form 1099-B. So the person did not receive 1099-B at all. And this is what we're going to check mark, and this is what we're going to see with the cryptocurrency transactions. A lot of them do not get reported on 1099-B, okay?
Yeah.
So this exactly same scenario happens with the long-term transactions. Now, for the long term, the portion that's interesting about the long term is this is where also, and there's always a debate about how you would like to present that information to Mr. IRS, but if the house was sold, it is very much so recommended to report it on 8949 with type in the explanation description of the property. That would be the actual address of the house, and then it's best to write Section 21 exclusion, okay? This what tells Mr. IRS that we're showing that there's no capital gain provided the taxpayer actually meets the exclusion. In order to have an exclusion for married filing jointly couple of 500,000, for single individual 250K, the taxpayer needs to have resided in that house for the 2 years out of the last 5, okay?
Mhm.
There is an exception for military members, and also exclusion can be prorated if the person had to move due to the loss of work or permanent and total disability. You guys following me so far?
Yeah. Okay.
Mostly, yes.
Okay, so any questions so far?
Mm. I have a question regarding the 1099 and the W2. If, for instance, I am an employee at Demo and I have shares with Samsung and I sell those shares within that year, will the income be charged to the W2 or the 1099? The income on the sale of shares.
If you are already in the possession of DMF shares, then it's going to be reported on 1099-B, and it's going to be reported on 8949. However, if you did not own the shares prior, let's say, to 2022, and the shares were bought by you at a discount through DMF, or DMF granted you shares in 2022, and then aka they vested and then you sold them. So the initial sale at a discount or the grant is going to be reported on W2, and then it's considered that you became an owner. Once you're an owner, any transactions are going to be reported on 1099-B. But to establish ownership, you need to either purchase them at a full price and then there is no W2 impact whatsoever, or if you purchase them at a discounted price through your employer, that's when they would be reported on W2.
Okay. Mhm. Okay. I have a separate question outside of this.
Uh-huh.
All right. While going through their forms, I saw that all their forms were for the US only. And I was wondering why they didn't have any state taxes, because they all work in the state of California. All their W2 says that they work in the state of California, but they didn't have any tax forms for California.
Yes. So when you go to the profile, you would go ahead and you would select California. You would add California as a state, and you would also select it for e-file. Once you're on the input screen, there is that state section, right? And of course, the California is going to be filled out here. If the state is not shown here, the information is not going to carry forward. So then once the state is added, well, before we actually preview, you would need to know whether the client is a full resident or partial resident or non-resident. In their scenario, it seems like all of their income is coming from California, so they are full year residents, okay? Another way to look at it, sometimes the address itself can give you a clue. So for example, if you see that it's one address on the W2s, but then the client gives you address, let's say that they're in Florida, you would say, oh, hey guys, by the way, you know, I see one address on the W2, but then I do see that now you've provided us with the Florida address. Do you live, you know, partially in both states? You know, do you reside in one of the states, or what's going on there? Okay. But in this case scenario, it seems like they have consistently stayed in California, lived in California, you know, and are planning to be in California. So now when you're going to preview this, it will actually be showing that they do have a California tax return, okay? And
Okay.
for the stage, guys, for the stage, I would like to do a separate session because each state has its quirks, perks, and it's a beast of its own. Okay.
Okay.
One thing I will tell you very quickly about California, just because we have so many clients out of California, I do suggest going down, locating. Give me 1 moment. Locating. That's another thing. So for California, there's also mental health service tax. It's 1% of income above $1 million. Let's see.
So if it's less than 1 million, it's 0.
1% over $1 million is used to calculate mental health services tax that is on top of the state income taxes. Okay, so it's additional liability. And I can see right now the penalty on 2019. I'll locate it for you guys later. Okay, but let's focus on the Fed for now. Okay, questions so far? Do you have questions?
She's been covering most of my major questions, so.
Okay, Fanny. Other questions? More questions?
You answered it recently, but I'll just ask again. You said the schedule 1, 2, 3, and ABCD to the rest, they are all under the 1040. Is that correct? Do they come in like, how do I say, a particular order? Maybe the numbers before the letters, or
sorry, what is the question?
my question
Was to confirm what you said earlier, that the schedule 1, 2, 3, 4 to I don't know what number, and the schedule ABCD to the last letter. I wanted to confirm that they are all under the 1040.
Yes. So conceptually speaking, right? Conceptually speaking, and I wish I could draw on here somehow, but you do have a 1040 that's a main form, right? If we're going to look at a separate lines where everything is coming from, we have quite literally over here, that is absolutely, it's packed with information. It says other income from Schedule 1. Very, very vague, because if you look at Schedule 1, it's quite literally all encompassing additional income and very much so all encompassing adjustments to income. So Schedule 1 is going to be, in a way, your page 1 adjustments, okay? It's going to be either negative or positive page 1 of a Form 1040 adjustments. Now, what are these? And this gives you the gist, but I can go over the schedule. So for example, taxable refunds, credits, or offsets of state and local income taxes. These are reported on Form 1099-G, okay, 1099-G. Alimony received is going to be only for the years prior to 2019. That's how that's going to be reported. After 2019, if the person's divorced, then this alimony is not considered a deduction. Also, it's not considered an income, okay? And this is why it's also asking right underneath it, date of original divorce or separation agreement, because Mr. IRS wants to make sure that it indeed is supposed to be shown as an income on this taxpayer's tax return. Next, we're going to go into again, this is all still Schedule 1. Business income and loss, just like we talked about, is a Schedule C. Okay, Schedule C. Other gains or losses, attach Form 4797. Now, sometimes it actually 4797, it gets reported on Schedule D, but sometimes it carries directly here, okay? Because if you're going to look at Schedule D, in certain instances, there's going to be a gain that's only reported on Schedule D. In certain instances, on the Form 4797, you're going to show partial gain reported on Schedule D over here and partial gain reported on Schedule 1 over here. Patrick, maybe take a note because we will need to discuss, note something along the lines of fixed assets depreciation, recapture. But to give you guys a sneak peek, if the person takes depreciation expense against the long-lived asset, meaning you have a computer you're going to use for 5 years, you have taken a depreciation expense of $500, leftover value of the computer is $500. At that point, you sold the computer for $600. What you're going to have to do is you're going to have to recapture portion of that depreciation. If leftover value was 500, and 100, it's above what the leftover value is, means that 100 is going to be recaptured, and it's going to be ordinary income, and it's going to flow into here as $100, and the 500 is going to be long-term gain from business equipment, which is not going to be on one of those things. It's going to be over here at the bottom, 4797 form. Okay, it's going to be reported here. Just a preview, but it's a very, very loaded topic. Okay.
Okay.
Then we're going to go further, and we have line 5, rental real estate. Rental real estate, that is Schedule E, page 1. You can have as many rental real estate activities as you want, and only 3 are going to be reported at a time on a Schedule E, page 1. So theoretically speaking, you can have 10 Schedule E, page 1s. Okay.
Yeah.
But even if you have, I don't know, 100 pass-through entities, what I was telling you guys before, you can only have 1 Schedule E, page 2. So no matter how many you have, they're going to be reported in statements if it's more than what fits on Schedule E, page 2. Royalties are also reported on Schedule E, page 1. Again, you can have as many Schedule E, page 1s as needed because you can have multiple sources of royalty income. And partnerships, as corporations, trusts, etc., these are your Schedule E, page 2, and this is what we see here, okay? So we see that the net for Schedule E, page 2, and we're going to go to statements, and it's going to be statement 1. It says Schedule E, page 2, Part 2, income or loss from partnerships and S corporations. These are all coming from partnerships. And the way these are even worded, these look to me like they're publicly traded partnerships, not just equity multiple, equity multiple. These look to me like publicly traded partnerships. And if they are, we must mark that they are publicly traded partnerships. So you would go to income tab, pass-through entities, partnerships, 1065 K1, and over here on the very first page, we must mark it publicly traded partnership, okay?
Okay.
Okay. Okay, so we see that the total of that income is 1859. That's what we're going to see summarized here, 1859. And of course, page 1, we know that it's partnerships, okay, from the Schedule E 1859, okay? This is also where farm income and unemployment compensation would be reported. There's also where other income, sometimes it could even be hobby income here, okay? So other, it could be hobby income that is reported here. And then we combine lines, and this is what we're gonna see flowing to page 8, to page 1 of the 1040, other income schedule 1, line 9. And give me just one moment, guys. I'm gonna mute myself briefly. All right, and I am back. So if you don't mind reminding me, guys, where were we at?
We're talking about partnership income.
What was that?
Partnership income, line 7A. Here, no, schedule where you are right now, the 1040, but 7A. Other income from schedule there.
Other income, right? Other income?
Yeah.
Okay. Okay, awesome. All right, so then we have adjustments to income, and of course, this is where IRS makes everyone laugh a little. They do have education expenses here. And for educator expenses, this is the teachers who earn the least amount of money and work the hardest. They only get 250 bucks to write off, okay? And we know
Yeah.
they spend much more on that. So
Hello?
yes, if you hear me being silent, give me just 1 second, then
Okay.
there's rhyme and reason for it, and I'll be right with you guys.
Okay.
Okay. Certain business expenses of reservists, performing artists, and fee-based government officials, attached form 2106. So, you may very well forget about this form for years to come, at least in the 2025 tax year, because this form is used for unreimbursed employee expenses, which are no longer in play. The only people who still qualify for this is actual military members. So that's the service members of the United States military. One thing that you will find very confusing though, if you're gonna click on deductions, there's still this form 2106. It is a very quick way to enter various vehicle and other unreimbursed expenses for partnerships, for rental property, for Schedule C, okay? But what I want you guys to keep in mind is that even though it says 2106, vehicle and business expenses, it doesn't mean that it's actual form 2106. You would not be telling it to go to a form 2106. You would be the boss of telling it where to go. And it's either going to go on Schedule C, which is business, Schedule E, which is rental, Schedule F, so this is your farm, okay? And this is specific. There's also farm cost of goods sold, depreciation, and inventory keeping forms. So that's where that's going to go. Schedule E partnership, Schedule E, Schedule SE partnership. That is a separate adjustment, but if you adjust it into a partnership, it will adjust self-employment portion of the income as well. We will be going over that, okay? But it doesn't matter that I clicked it. It's not going to go anywhere. And then Schedule E, S Corporation. This is for unreimbursed expenses. Very, very, very controversial topic. If you ask me, there is only rare occasions nowadays when this is going to be used, and most likely, if you're in doubt, which you should be every single time you're trying to give taxpayer unreimbursed business expenses for the S Corp, definitely consult me first. Let me know what you're trying to do, why you're doing it, because in 99.9% in perpetuity, this is not allowed, okay? Not allowed. So forget about election number 7.
Okay.
And then Schedule E, estate or trust. Again, questionable, a little bit doable, but I would say you're not going to be doing this in, at least quite foreseeable future. This is not going to be happening, okay? Okay. And also just let me know when you guys feel like, your eyeballs are popping out or something, and if you want to take a break, okay?
Okay.
Okay.
Health savings account deduction. Okay, health savings account deduction. Attached form 8889. Honestly, quite simple. If the person contributed to HSA, which is health savings account, they may qualify for the deduction. For this particular client, they're completely phased out of it. And we're going to have plenty of examples where we can actually look at the form. Okay, so if you don't mind, we're going to skip it for now. Moving expenses for members of armed forces, yet again, so this is specifically for the move, okay, for the move. Armed forces do get relocated, from station to the station. Also, they do get reimbursed certain expenses. So this form reconciles, and the reason I'm even briefly telling you about this is because you're most likely not going to see it, but just be aware of it. They do get reimbursed for the move. So on 3903, you would be reconciling whatever they reimbursed versus whatever they actually spent. The remaining either expense or other adjustment, okay? If they actually, well, there's going to be no gain, but if they did come out of the pocket more, it's going to be reported here. Now we come to an interesting thing, that is deductible part of self-employment tax attached Schedule SE. Schedule SE, as it does suggest, it's Schedule of self-employment taxes. Self-employment taxes are going to show up here on the page 2, including self-employment tax. So those are going to be other taxes. They are being slapped on top of the federal income taxes, okay? They are going, in this scenario, this guy, he actually doesn't have any self-employment taxes. However, judging by the capital gains amount and other investment income amount, he does have other taxes, which are net investment income taxes and additional Medicare taxes. And those are going to be additional Medicare tax form 8959 and net investment income tax 8960. Okay, we're going to take a brief look at them just in a little bit. But going back to the self-employment taxes, portion of them is deductible, which is 50%. Is deductible on the page 1, okay, against potential taxable income. This is where you can also take advantage of writing off SEP, simple and qualified plans. Huge topic. We're not going to touch on it as of yet, okay. Self-employment health insurance deduction, exactly what it sounds like. This is quite literally for self-employed people who have either Schedule C or Schedule E page 2 income from partnerships that is subject to self-employment, or in certain cases, Schedule E, page 2, income from S corporations, where the, well, it wouldn't quite literally be be taken here as a deduction, but it might. There is also a way to show that, okay, to put it through here. Penalty on early withdrawal of savings. Honestly, very rarely see this. I don't think we have all that much clients like that, but who knows? Times are changing. Alimony paid. Remember, we talked about what happened in 2019. 2019, this is the reason that Mr. IRS is asking, you know, when was the date of the divorce? Here they're asking it again because after 2019 tax year, well, 2019 and after, I should say, alimony is not an income, but it's also not a deduction. IRA deduction. Large, I would say it's a larger topic for conversation, but for right now, what I want you to remember is certain people below the threshold that is about $180,000 from married filing joint filers, I believe, only a portion of up to $6,000 can be taken as a deduction on their tax return. These people have definitely phased out, and I'm going to take a break. Give me just one moment, you guys. I'll be right back.
Okay.
And so these people have phased out, even though they do qualify to contribute to traditional IRA, they're not qualified to contribute to Roth IRA. I do believe the pause is necessary here. What is traditional? What is Roth? What the heck is the difference? Traditional, it is considered a tax deferral, meaning if you do contribute up to $6,000 this year, you can or may qualify to take $6,000 as a deduction over here on your tax return. However, a lot of taxpayers, they phase out of that deduction, okay? So then they actually develop basis in their IRA. Now, regardless of the, well, not regardless of the basis, but the way the traditional IRA works, because it is a deferral, meaning you could get a deduction, you either will track the basis if you did not get a deduction, or you will have zero basis. But when you're withdrawing the pension, that is IRA specifically, when you're withdrawing traditional IRA, when you retire, that is going to be taxable income in excess of the basis. So whatever earnings there are in traditional IRA, even if all of it, let's say, I don't know, you've contributed 60K, it grew to 400,000. You're going to be withholding from the, you know, from the 400,000 pool. Every single time you will need to calculate what is the percentage of the bases are in that 400K pool, and you will pay the taxes on the amount that is over the basis, okay? That's if you have basis. If you have been contributing to IRA and you have not been rather you have been taking a deduction, every single time when you retire, you withdraw money, the full amount is going to be taxable. With Roth IRA, however, whenever you retire and you take the money out, both the body of the investment and the earnings of that investment is going to be tax-free, okay? Tax-free. So one takeaway from this could be is that since this person doesn't qualify for the IRA deduction, what they can do is they can contribute to a traditional IRA, not take the deduction, full 6,000 becomes the basis, and then they convert it to a Roth, and that's going to be a tax-free event to them. Once it's a Roth, they can draw it once they retire tax-free. It is called backdoor IRA. Backdoor IRA, okay? Student, oh, sorry, go ahead.
Oh, no, nothing. Sorry. I just have a cough.
Student loan interest deduction. So student loan interest deduction, exactly, you know, just like it says it is in this one, just read the line. And most of the taxpayers that we prepare tax returns for, at least, you know, as of now, the way the stock market's going, who knows? They do not qualify for this, okay? But technically speaking, whatever you paid as a student loan interest, you can deduct on your tax return. That's where it will show up. Tuition and fees attached form 8917. This is specifically for tuition and fees deduction. And it is either tuition and fees deduction or American Opportunity Tax Credit or Lifetime Learning Credit that the taxpayers can take. And remember, going back to very beginning of our conversation, credits are better than deductions because with credits, you get dollar for dollar. Deductions, well, they work in your respective highest marginal tax rate, meaning your tax bracket. And for, let's say, taxpayers with average income, credit is always better than deduction. And that's it. Then you tally them up and you're going to have adjustments to income. Okay. They are going to go to line 8A, adjustments to income. Okay. So we have other income that's going to come from Schedule 1, and we have adjustments to income that's also coming from Schedule 1, but two separate parts. Okay. So Schedule 1, additional income, tally up goes to one line, line 7A. And then we have adjustments to income that are going to go to line 8A, okay, once we tally them up. So that's going to be what gets you at the end of it all to adjusted gross income. Very important number. Quite a lot of thresholds, you know, are based specifically on adjusted gross income, okay? What kind of questions do you guys have so far?
I have none for now. I'm still thinking.
Okay, Patrick, are you still with us?
Yeah, just a little bit over my head, but I'm gonna rewatch this and try and digest it a little better again. So
Okay, so let's do this. What's the best way? Because this is going to be Patrick, do you know if I stop it, is it going to save it, or if I restart it, it's gonna erase this session?
I am not 100% sure. I'm assuming it will come